US stocks see their worst day since 2020. Things are pretty bad, but they're probably going to get a lot worse. But there are bright spots in the market offering investors good returns. We'll cover those and what you need to know. Welcome to the Daily. My name's Jessica Amir, market strategist here with Mumu. Welcome to this fourth day of April. So we're awaiting retaliatory tariffs from other countries to be announced, and that's probably going to put more pressure on stocks. For one, we saw Canada overnight announce that they're going to put a 25% tariff on all American-made vehicles. As I said before, it's the same playbook of 2018, Trump's first term, and that brought on the most recent trade wars that we can think about. Now, back then, we saw retaliatory news come out, and that pushed stocks to lower ground. That is what's happening now, and that's what we're expecting to come ahead. Well, that's what I'm expecting ahead. Now, it's fair to say that the US tariffs announced yesterday were far worse than most people expected. The world is basically facing greater economic pain, business pain, consumer pain. A wide range of goods are about to get simply more expensive, even for us in Australia. Computers, phones, cars, clothes, you name it. And this pain right now is being reflected in fierce selling in stocks and commodities. That's basically because the world is bracing for slower growth ahead. And that's why we have to remember that the market is forward-looking by 6 months. So if we do have a look at the Nasdaq 100, yes, it's dire. Nasdaq 100 fell 5.4% overnight. We're also seeing pain prick up, the pain and fear gauge reflected in the VIX. That surged to a level of 30. That's its highest level since August 2024. Meanwhile, we have seen the 10-year bond yield continue to fall as well. But if we think about stocks that are being hit the hardest, this is something for you to consider. Dell, for example, dived 19%. Other consumer-facing electronics companies, HP, a similar fate, down 15% in one day. Nike, just do it, huh? Down 14%. Remember, most of their growth is pegged to the Chinese consumer. A lot of their goods are even made in China as well. And even think about homegrown Ansell. Ansell, we're displaying that chart on the screen. For those tuning in on our podcast, we're basically showing the big drop in Ansell's shares. Yesterday on the ASX, they fell like a knife, down 15%. Now, simply, we need to really remember that businesses are bracing for their costs to surge and for their sales to fall. It's bad for businesses, but it also means a higher cost globally, and also for Australian consumers too. Again, just remember, stocks markets, they're forward-looking and they're factoring this in now. And that's why this painful readjustment is probably going to continue. Now, I mentioned the word pain. With economic pain being so dire, traders now expecting the Reserve Bank of Australia to cut interest rates 3 times this year. Ladies and gents, would you believe it or not? I had a look at the futures this morning. There's now an over 100% chance the RBA will cut rates in May, August and November. That's what futures traders are telling us. So expecting 3 interest rate cuts in Australia this year. So that could be good news. But right now, we're just basically seeing markets continue to respond. But there are a couple of options. It's not all doom and gloom. I really want you to remember these 3 couple of things. Firstly, if you do have cash, you want to buy something, you're experiencing FOMO and you want your portfolio to be doing well while markets are falling, there's good news. We are seeing investors be rewarded by buying into 20-year bonds. For example, think about the TLT. Now, this is a foreign concept for some of you, I know, so bear with me. Now, this is a 20-year government bond. This ETF, for example, is paying a yield of near 4.1%. What is a yield? Well, think about a dividend, right? It's basically the same thing. And this ETF itself has grown in value by 5%. So your maths, if it's right, 9%. So that's basically, you could call it a 9% return just for 4 months, almost not even 4 months of investing in a boring government bond. This is a very simple example of how sophisticated investors are growing their portfolios or cushioning the blow while tech stocks and growth stocks are dropping like a stone. This can simply offer you peace of mind and protection because we are bracing for a storm in shares. Secondly, what else do you do while markets are falling? Well, you can stay the course and white knuckle it. Simply make fists and just hold on. Or you could buy into quality indices, remembering markets, specifically the S&P 500, the Nasdaq 100, and the ASX 200, they've always recovered from market crash. But you have to take a long-term view. Now, remember, if the 2018 tariff trade war repeats, remember the ASX 200 fell 15%, the Nasdaq 100 fell 24%. Now, we're not there yet. The Nasdaq 100 is down about 13%. But remember, basically, more pain is probably going to be ahead. The third scenario, again, thinking about 2018, what do you do now? Well, as I just said, US stocks have always recovered from a crash. What's the recovery look like after a severe trade war crash? Well, for US stocks, back in 2018, the US market crashed 24%, but after 1 month, it was back at record all-time highs. In Australia, it was a bit of a longer recovery. The Aussie market was back at a record all-time high after 3 months. So for now, ladies and gentlemen, what do you do with this information? Well, simply await retaliatory tariffs. And this is why retaliatory tariffs are probably going to pressure stocks down unless we see Trump pull a rabbit out of a hat and he drops all tariffs and markets rebound and everyone rejoices tomorrow. I think that's unlikely, but let's see. There's plenty of gains to be made, and there is always a bull market somewhere, and I think that could be in bonds and gold. But let's see. Stay safe, happy trading. I'll see you for the weekly.